Hey there, Chris Middleton here with the MakeTaxesFair.com team. We are here today talking about the accountable plan, what that is, what that even means. If you're watching this on YouTube or finding this video elsewhere that we're hosting it, just know that this is part of the Launchpad series that we call what we call our Launchpad series, which is kind of a DIY track meant to kind of guide you and help you initiate tax strategy if you're paying 50,000 or less in taxes. Now, this strategy, just because I'm recording this for people that are paying 50,000 or less in taxes, does not mean that it's not very, very applicable to almost every business at every level. This strategy can become even more powerful if you're paying well over 50,000 in taxes, right? If you have higher income, and you're in higher brackets. So this is a fantastic strategy. I'm excited to share it with you. So that being said, let me launch my screen sharing here and let's rock and roll. So the accountable plan is really designed, we're going to walk through a little bit what this is, who this is appropriate for, but it's for tax-free reimbursements for business owners when this is done right. Now, this is really key when it's done right. So I'm live and unscripted here, but just note that this is general education. It's meant to be educational only. This is not tax or legal advice. It's meant to give you a foundation and clarity around the strategy. And, legal advice and tax advice is when you sit down with somebody, a qualified professional, and say, hey, here's my stuff. This is my situation. Let's talk about me, right? That's when it's legal and tax advice specific to you. But the goal here is by the end of today, you're going to know, or at the end of this video, you're going to understand what the accountable plan is. You're going to understand the impact of this strategy for tax savings and cleaner cash flow. And you're going to be able to say, hey, I understand, what are the first steps that I need to take action and actually utilize a strategy like this to reduce my tax bill. So really, the accountable plan is all about optimizing your deductions, right? Missing deductions. And the problem that we face here is expenses that are paid for personally that don't ever make it to your profit and loss. And I'm going to say this for S corporation owners. Listening with me? Paying attention? Haven't put you to sleep? Okay. So if you're an S corporation owner, I challenge you to look where on your tax return and where on your financial statement or your general ledger is your home office claimed. Think about that for a second. I'm going to show you in a moment why that's probably not showing up on your P&L and why, even though you think it's being deducted on your tax return, it's not. So that's what the accountable plan really is designed, is to help mitigate the loss of deductions, or what we call the quiet deduction leak. Because there are things that you should be and are paying for personally, because your home, if you're paying rent, your home is not 100% business use. So it's very rare that you see 100% of your home being paid for out of a business legitimately. It's very rare that you see certain things being paid for 100% out of the business legitimately. So the goal is that we're going to stop missing those deductions by reimbursing them properly. So if you're using a personal credit card or a personal debit card, those things should not be included in the business, because to keep it clean, if you're a sole proprietor, you're allowed to mix personal and business, but to keep it clean for audit purposes, you really want to keep those things separate. What happens is, if you don't have receipts and logs, the deduction is harder to defend later, or harder to define and capture right now. And if you go about reimbursing those things the wrong way, those things can be taxable later on. So here's an example, diagnosing the doctor, right? A while ago, I've encountered this multiple times. There's a physician, partner in a medical practice, and he was paying for some things personally, right? His cell phone. There's one clinician that I worked with years ago. He was a partner in multiple urgent care facilities. And while he would go to one as a regular kind of assignment, he would float between the urgent care facilities to support and back up based on volume or traffic. So, his cell phone, even though his wife and kids were calling him on that cell phone, was also used for his work quite a bit. And so he was paying for that personally. The partnership, he had 10 partners in this business, didn't have, they weren't all paying for their cell phones through the business. Some of his licenses he was paying for personally. He's never got around to saying, hey, can the business pay for these? Continuing education. So there were certain things that he was like, hey, I'm interested in this class or this education seminar. And he would go and do trainings and things to keep current on what's going on in the world in his profession. He thought all those things were being claimed on his taxes, right? He said, well, I gave all that information to my CPA. The problem is the CPA was not the same CPA that was doing the tax return for the partnership. And so when we looked at his tax return in detail, all that information, we were like, well, it should be, I think he had totaled it up as about $4,200 for the year. Nowhere on his tax return. And I said, here's why. It's never being submitted to the tax return for the corporation or for the partnership. So there are ways to go about that if you are not an S-Corp or not a C-Corp, which we'll talk about here in a second as well. But really, this comes down to one of the core things around the accountable plan is it's minding your mindset, right? A passive or reactive mindset is going to cost you thousands of dollars in taxes. That's true for this strategy as well as others. And the accountable plan, if you were to sum it up in one sentence, and I'm not asking you to, it's a very long sentence, so I'm not asking you to memorize this, but pay attention, because an accountable plan is a company system for reimbursing employees, including the owner, for qualified business expenses, tax-free to the recipient, and deductible for the business when the rules are followed. Okay? So what that means is, if you're looking at this, the business expense paid for by you personally, submitted through an expense report with the receipts and the purpose for the business. Hey, I'm paying for my cell phone. I use my line only, not my kid's line, not my spouse's line, my line only for business. And then reimbursement paid by the company. That's when that system works to make you whole and capture those deductions as a business expense, because now it's been paid for by the company. It's very important here there's two different paths. There's the accountable plan and the non-accountable plan. Folks, here's the secret that really shouldn't be a secret. The government, the IRS, does not actually require you to have a written document. You're not required to have a written document for an accountable plan. That's why it's not talked about. It's a requirement. Everybody talks about it, right? But ultimately, it's optional. But if you have that written policy in that plan, you are empowered, and reimbursements are generally excluded from income. That includes business deductions. They count as business deductions. They're not treated as W-2 wage, and you are required to produce timely proof. So you have to abide by the terms of the plan. Non-accountable plans, you run the risk of the reimbursements becoming taxable compensation. They can be reported and likely will be reported as wages. There's payroll tax exposure, and again, often caused by missing the rules. So the paperwork is really not busy work. It's what protects the deduction. It's what protects the write-off. So this is for you, or who needs this. It's a strong fit for you if you're an S-Corp owner, a C-Corp owner, a W-2 employee of those entities, or you have teams with out-of-pocket expenses. So you can be a partnership or an LLC and have teams that are W-2 and have out-of-pocket expenses. This is good for you. Notice I said it's not a strong fit or a good fit, but it's good for you to know if you're a Schedule C, sole proprietor, single member LLC, or a partner in a partnership, or have owners without corporate employee status. The reason why it's good for you to know is these principles are very broadly applicable to all types of businesses. And so this is good information for when you're ready to graduate to S-Corp owner, C-Corp, or a LLC that's made one of those elections, right? We'll talk in a different video about partnerships and what's called unreimbursed partner expense clause. That's how you would handle if you're a partner in a partnership. You would handle it's under the UPE, or unreimbursed partner expenses clause, that is required to be in your partnership agreement if you're going to do partnership expenses, to be able to deduct those on your tax return. But for the moment, we're going to focus in on this is optimal for S-Corp and C-Corp owners, or folks in this kind of bracket or tier there. Okay, so there are 3 irrefutable rules of the accountable plan. So the first and foremost is there's got to be a business connection, a bona fide, legitimate business connection. The expense has to be paid or incurred while performing services for the business or in conjunction with that. There's no really getting around that, folks. The necessary and ordinary components of that, and hey, I needed to do this because I'm engaged in the commerce of my business. That's a hard and fast rule. Documentation that must be kept. You have to document the amount spent, the date you spent that, the place, the business purpose, right? You got to keep the documentation around this. And then if there's a return, there needs to be a return of excess. So the example would be anything above the substantiated amount needs to be returned to the company. So using the cell phone example, let's say my bill is $100. It's never exactly $100 even in real life, but let's just, for the example, $100. And my line is $59. And everybody else's line makes up the balance of that. If I ask for reimbursement of the $100, the company should say, hey, wait a second, your spouse, your kid's cell phone bill, they're not employees of the company. We're not going to pay for those. Like, we're only going to pay for yours. So that would be, I would need to return that $59 $100. So for what, $41, can't do math in my head. $41 excess is what I would need to return to my company, right? So that's how that works, is you got to substantiate the amount. And if you're receive more than you substantiate, you need to return that. So that is a rule. These are the rules that keep your deduction in the safety zone, right? That keeps those deductions safe. You got to play by those rules. And if you fail any one of these, you're gonna fail the tax treatment of these. So the timing guardrails, right? To keep the reimbursements from being a year-end guessing game and being disallowed by the IRS and say, hey, those are not reimbursements, those are income subject to income tax and payroll taxes. You really need to abide by the 30, 60, and 120-day rules. So 30 days, you can advance an employee within 30 days of the expense. You can say, hey, we're going to go ahead and cough up the money. Here you go. Here's your $59 for the cell phone. Here's your, $289.23 for your mileage. Here's your home office reimbursement. You can give them those things, but they got to substantiate that within 60 days. My advice would be marry these two together. So don't advance and ask for substantiation later. Kind of bundle these together. Keep the substantiation and the payment together as a condition of, hey, we've got to substantiate the expenses first. If there's a excess, that excess or overage needs to be returned within 120 days. Otherwise, again, the IRS, if you don't abide by these rules, they can say, hey, that's compensation, that's W-2. We're going to charge payroll taxes on that, the whole shoot and match. We don't want that. That's not good, because then it goes from tax-free to taxable. Okay. Expenses, common expenses to look for, and just keep in mind, not every expense here is automatically reimbursable. For every category, the question is, for your business, is this an ordinary and necessary business connection, bona fide, legitimate for you, and properly documented? But these are examples. So home office, rent, portion of the mortgage, utilities, repairs, depreciation allocation, etc., vehicle mileage, vehicle expense, business miles, parking, tolls, etc., etc. You can read. I'm not going to read all these to you. You're welcome to pause, take a screenshot, look at this. But bottom line is, every category, you have to have those three things: business connection, documentation, and proper reimbursement flow or timing, right? Again, this is a S-Corp hot topic. Home office deduction, why this matters. Again, it's often a missed deduction. People think, hey, I, I'm claiming this on my tax return. Okay, if you are, where is the home office deduction, the portion of your utilities, all of that, where's that showing up on your P&L? I challenge you to look at that. If it's not showing up on the P&L, why not? And if that's the case, is it not also showing up on your tax return? Um, the expense report is what unlocks this reimbursement, right? The reimbursements for them to be tax free, that really has to be through that expense report. So the home office opportunity is, the proof you need to keep is the expense proof, your utilities, your rent, your mortgage. It's got to be exclusive and regular use, business purpose, and for the employer convenience. And the proper flow, and this is where I challenge people and say it's not showing up on the tax return properly with the right documentation. Your tax return preparer may just be throwing something on the tax return, but if it could be undervaluing what that deduction should be. You should be submitting a expense report for the company to say, hey, here is the portion that I should be made whole because I'm using my home for the business. I'm using my vehicle for the business. I'm using my cell phone for the business. You get the idea. And then the corporation reimburses you and then records that deduction on the financial statements. That is the magic, and that's the missing link that a lot of people don't get. Folks, just a reminder, the golden rule for a home office is it's got to be exclusive and regular use. Used consistently, 100% business. So, true story. I have a content creator. Recently talked to him. He sells stuff on TikTok. Awesome. So he uses his bathroom, his kitchen, his bedroom. He gets a household item and then goes and says, hey, this is an amazing thing. Look, I can use this insert product, the pumice stone, let's say. I can use this pumice stone. Look how amazing it is to clean the tub. And look, I can take it over here and clean the sink. And oh my gosh, I can use it to clean the couch, right? So he's filming all over his home, but the IRS says, hey, you're also using your kitchen. You're also using your bedroom for purposes other than business. So technically, only the area that is your dedicated office setup is allowed to be deducted, and the portion thereof of that. Okay. Adequate accounting, what does that look like, right? So the goal is to create a record that a complete stranger could understand later without any input from you, without any, oh, well, this is that, or assistance, right? So date, when it happened, a place where it happened, and who's involved, the amount, exact dollars, not rounding, not guesses, business purpose, and proof. So again, if you don't have the right documentation, you don't have confidence, and that leads to, hey, will we survive an audit? We don't like to say the A word, audit, but if it happens, we want to make sure that we have the right information and that we're tight on our documentation. Tax impact. So qualified reimbursement, let's say it's $1,000, applicable tax rate times, so 1,000 times the tax rate equal, is your estimated savings. That should be a equal sign, not an X. So sorry about that. But live and unscripted, like I said. So if you're a C-Corp, 21% flat corporate rate at the moment. S-Corp, it's a flow-through individual rate at whatever the owner's marginal rate is. So if you have somebody at the 37% bracket, guess what? That $1,000 reimbursement is going to be worth $370. On top of that, the payroll tax treatment. So again, an example, and I hate the fact that this is a nice round number. Folks, in real life, is your utility bill always, $200 every month? No. Is your cell phone bill always $100 even? No. In real life, things are odd. Life is odd. I'll just say that, right? So you want to make sure that you are keeping reimbursement, and I'll hit on that in a minute. But Let's say it's $6,000, for example, at 30% illustrative combined tax rate. And so the tax impact of that would be 1,800 bucks. So the real win when you're doing the accountable plan the right way is you have organized reimbursements, clean records, and tax-free cash flow. It's great. So your steps to put this into motion, right, is adopt the plan, put the reimbursement policy in place, define the categories. What is eligible for reimbursement? What is not eligible for reimbursement? Collect the proof, the receipts, the bills, the logs, the business purpose, all those things. Submit the reports, use a monthly reimbursement form, right? Pay out the reimbursements correctly. Reimburse them from the business account. Ideally, you can run this through payroll. You can add, for many payroll providers, you can add a reimbursement line that is not subject to payroll tax and income tax, but you can run it through the payroll program as a box 14 item on your W-2. You need to file those records, right? So once you have done the things, you need to make sure that you store and digitize that information. And don't wait till tax season, right? Build this into your monthly process. Speaking of your kind of monthly process or cycle, right? In the first week of the month, it could be hey, I'm going to gather the receipts. I'm going to gather all the information. And by the 10th of the month, you're going to say, hey, I'm going to submit the report. And by the 15th of the month, I'm going to approve and pay that report. And then at the end of the month, you're going to say, hey, we're going to gather all that information and pull it all together to digitize that. This is kind of a good cycle. And you notice it's in a circle because guess what? This is kind of that hard, boring work. But once you get used to it and say, hey, this is what we're doing and this is how we do it, I've seen clients get into a rhythm where they can knock this out 15 minutes a month and they're good, right? So if you could spend 15 minutes a month and capture an extra $3,000-$4,000 in tax savings, and that's worth $1,800, $2,000 to you, is that worth your time? I would argue yes. 15 minutes a month is what, 4 or 5 hours a year for 1,800 bucks. I'll put in 4 or 5 hours worth of work for 1,800 bucks, especially if it's kind of spread out over time. You want to build your audit proof folder, right? Your audit defense is not a single document. It's a stack. It's that daily, weekly, monthly stack of effort. So you really got to have a written accountable plan policy for this to really shore it up. Have those expense reimbursement forms. Document your home office calculation. Document that. Have your corporate resolution or minutes, receipts, bills, and then proof of reimbursement. Those are kind of your core, what we need to do. The mistakes that break this strategy, folks, I see this all the time. Somebody that pays a flat monthly stipend, $2,000, $1,000. Hey, I'm just going to do a flat amount every month, put it on autopilot, and never have to think about it again until you're audited. And then you have to defend that amount. And they say, that $1,000 a month you did, that's actually, if you look at it, your expenses should fluctuate because, again, life is not nice and even. Life is odd. So you should be seeing a fluctuation in those reimbursements. That looks like wages that you're paying. Okay, now you have to pay income tax and payroll tax. That can add up. Personal expenses disguised as business expenses. Folks, if it's not ordinary, necessary, legitimate, bona fide business, don't do it. Like, just keep business and personal. Using year-end estimates instead of real records. In my opinion and my experience, estimates have always been less than the actual real numbers. That's just in my experience. When people have gone back and done the work, they're like, wow, I've been shortchanging myself on these deductions. People that don't return excess reimbursements, that's a problem. If you get reimbursed $1,000 and it should have been $899, that excess needs to be accounted for and returned to your employer, even if you are your own employee of your own company, right? Missing receipts, logs, or business purposes, or salary recharacterization arrangements. That's a whole thing in and of itself. But if you're saying, hey, we're paying out this thing and we're going to call this wage, or it was paid out as salary, but now we're going to recharacterize at the end of the year or after the year ends and say, oh, that was a reimbursement. That's a no-no. You got to if it's set W-2 salary, leave it as W-2 salary. Don't try to back that out and make that something that it's not. Okay. So, kind of your steps of here's what we do now. Again, the goal is not to master everything in like a week or a day. This takes time to properly implement and properly get into a rhythm and a habit of doing this. So, you really want to confirm your entity type. You want to adopt an official plan, choose your expense categories, set up your reimbursement process, gather your records, run the reimbursement, and then review what you did. Say, hey, pull in your accounting team, pull in your bookkeeping team and say, hey, did I do this right? Develop that habit. And it's really great. I'm going to plug our slogan here. Friends don't let friends overpay the government. Folks, if this is helpful, get the win by creating the momentum and start and engage an accountability partner. Is there a self-employed person? If you're watching this, you're like, man, Bob could really use this, or Janet could really use this. I should share this with them. And now you have an accountability partner to say, hey, have you done your reimbursements this month? And, set a date. Whoever checks in the first, whoever checks in last on their accountability, hey, I did this. They buy coffee at the next, time you connect for coffee. Make it a game. Like, have accountability partners and people that you can say, let's do this together. Rising tides lift all ships. So bring people together that are interested in doing business right and doing business in an efficient way. I like to say doing business on purpose. Okay. We have some tools that we're going to put out together or putting together that are available inside of our community. So this is a good time to plug our the Launchpad series that I mentioned at the beginning of the video. These tools are found in our free and VIP communities, as well as other things inside of those communities. So an accountable plan playbook for you to look at and to say, here's how I execute on this. A sample accountable plan that you can use as an example. Monthly worksheet or reimbursement worksheet, home office calculator, mileage receipt checklist, and an owner compliance list. So doing the hard, boring work, there is no substitute for that, but we're trying to make it as easy as possible. Folks, an accountable plan is a part of an overall tax plan. So in the Clear Edge framework that the Make Taxes Fair team has, we operate off of and help people get organized and to have deduction optimization. Those are two of the pillars in the Clear Edge. That actually stands for deduction optimization and getting organized in the Clear Edge framework. The Clear Edge framework is how the lens by which we create a custom tax strategy roadmap for our clients. If you have not gotten a tax strategy roadmap, you should check that out at maketaxesfair.com/get-my-roadmap. And that brings us to the end, which is our why. We are maketaxesfair.com. That's our mission, is to make taxes fair. Folks, friends don't let friends overpay the government. We are proud to serve our online and entrepreneurial community. I did tell you that this is live and unscripted. We're grateful to serve our entrepreneurial friends. Check out our communities at the maketaxesfair.com/r-communities. Check out our roadmap. If you enjoyed this, if you're watching this on YouTube, get into our communities. If you enjoyed this and said, hey, this was dope, helpful, awesome, let us know that. Let us know what else and other types of resources that you would like to see. If you're a client of ours, we hope that this has been helpful. And we try to use things like this to give you before we meet so you can go through some education so that we're not spending our time kind of teaching you in our appointments. We're using our time when we meet in executing and actually taking action. With that being said, remember that I like the analogy of a hydroelectric power plant. And you could have the power plant sitting there, but if there's not water moving through that machine, guess what? There's no power. I liken that to knowledge is potential power. Knowledge is power that could be applied if it was put into motion. So I implore you, take action. Say, hey, I learned something today. I see how this could impact. We call this the FIRE method. I focused, I learned something. I see the impact on that. Now I'm ready to respond, ready to do something with what I've learned here today. So that's how you get to efficiency. So focus, impact, respond, and efficiency. Thank you for being here. Thank you for your time. Hope this was helpful. See you in the next video. Bye for now.